Hello there and welcome. I'm Jolandie Vermeulen, Head of IGrow Trust. We're going to look at one of the most important decisions any property investor will make, and that's choosing the right structure to hold their investment in. Should they buy in their own name, through a company, or through a trust? Each option has very different implications for tax, estate planning, and asset protection. Let's get into it. Let's compare the different entities and show how each affects how you control the asset, how it impacts your tax position, estate planning, or what happens to the assets when you die. We're going to walk through each type of entity. Before we do, here's the important context. There is no single best structure for everyone. The right choice depends on the client's income, tax position, family situation, and long-term goals. What this gives you is clarity on the trade-offs and a good idea of why we recommend a particular structure setup at IGrow. Let's start with control. As an individual, you own the asset directly. It's simple and straightforward. With a company, you're the director, so you still have indirect control. With a trust, you're the trustee and beneficiary. You don't legally own the asset, but you do control it and its proceeds. That distinction matters a lot from a legal and estate planning point of view. From a funding perspective, buying in your personal name is the most straightforward. Shelf companies are available for a company structure, but shareholding needs to be transferred. There's a step involved. A trust requires formal registration, and that takes time. Lastly, let's look at financing. When it comes to the bank's mortgage bond, individuals can typically access up to 100% financing. A company can also reach 100%, though 80 to 90 is more realistic in practice. And for a new trust, the bank will generally lend up to 80%. One important flag there is if there's a delay in trust registration, it can create a transfer duty or capital gains tax liability. That's why getting the trust set up correctly and timeously throughout IGrow Trust is so important. This is a practical point that can catch investors off guard. The 80% gap for trusts means the client might need a larger deposit, worth discussing earlier in the investment conversation. IGrow Home Loans works alongside IGrow Trust to navigate these requirements, so you can reassure the client that they won't be doing it alone. Let's look at income tax on rental income. This is where it gets interesting from a tax perspective. If you own property in your own name, rental income is added to your personal income and taxed on a sliding scale from 18 up to a maximum of 45%, depending on your total taxable income. A company is taxed at a flat rate of 27% on its income, which can be much better than personal income tax. A trust is taxed at a flat rate of 45%, the highest of the three, with no sliding scale. However, if income is distributed to beneficiaries, it's taxed in their hands at their individual rate, which may be significantly lower. As an example, say you have a spouse, 2 children, and your retired parents as beneficiaries. You can pay their expenses, such as school fees or retirement homes payments, out of the trust, and they will only be taxed at their individual rate, which could be much lower than yours as a working professional. Capital gains tax or CGT applies when you sell an asset for more than you paid for it. The key thing to understand is the inclusion rate. That's the portion of the gain that gets added to the taxable income. For individuals, 40% of the gain is included in the taxable income. For a company, 80% of the gain is included, taxed at 27%. And for a trust, it's also 80% inclusion, taxed at 45%. One area where individuals have a clear advantage is CGT exclusions. Every individual receives an annual exclusion of 50,000 Rand, meaning the first 50,000 of capital gains each year is tax-free. In the year of death, that exclusion increases significantly. It's now 440,000. Companies and trusts receive no annual CGT exclusions. Asset protection is one of the most compelling reasons investors choose a company or a trust. If you hold property in your personal name, it is fully exposed to your personal creditors. If you face insolvency, that property is at risk. But if assets are held in a company or trust, they are separated from your personal estate and protected from your personal creditors. That's a significant safeguard, especially for business owners or professionals with personal liability exposure. This could resonate strongly with clients who are business owners or self-employed. Ask them, if something happened to your business, do you want your investment property to be protected? There are legal requirements and timing rules around when these protections apply. A trusted attorney at IGrow Trust can advise on these properly. Finally, let's take a look at what happens to investment property assets when the investor dies. This is where the choice of structure has the biggest long-term impact. If you own property in your own name, it forms part of your personal estate. That means it may need to be sold when inherited to cover estate costs or to help divide the estate between inheritors. It's subject to estate duty, executors' fees, and capital gains tax on death, and the process can take years and cost the estate significantly. The shares of a company also forms part of your estate, subject to estate taxes, but with a trust, the assets does not form part of your personal estate. This is why we recommend a combination, company and trust structure, to get the tax benefit of the company while still getting the benefit of the trust, which keeps the company and the properties owned by the company out of your estate. For investors who are building long-term wealth for their families, this is one of the most powerful arguments for a structure, as the loved ones can inherit the investment properties entirely tax-free. So to summarize, buying in your personal name is the simplest and most accessible route. And for many first-time investors, it could be the right starting point. But as your portfolio grows and asset protection and estate planning becomes more important, a company and trust structure can play a significant role. That's exactly why IGrow has a dedicated team of trust and tax specialists ready to help through IGrow Trust and IGrow Accounting and Tax Advisory. Now you have the tools to do that.